Hi everyone. In this session, we will discuss the first reading of our FRM Part 1's curriculum. The reading's name is The Building Blocks of Risk Management. Now, this reading provides an overview of the concepts which are covered in detail in rest of the curriculum. So that's why we have to just understand the basic definitions of the concepts. And whenever that concept comes where the concept is covered in detail, I will provide a specific reference. Okay, this particular concept is covered in detail in coming chapters. Okay. Now here, for this video, we will use Falcon Defense notes. If you like these notes and want to access these notes, then the link will be available in the description. To access these notes, you have to enroll for the Essentials course, and Essentials course provides all the essential content for your FRM Part 1's preparation, which includes mock test, question bank, and these notes as well. Okay, so these are the colored notes. There are the color indications. All the important points are highlighted in the red color. Now, here, with the notes, mock test and question bank, we also have fast track notes. So if you are revising your curriculum, then and for the same chapter, here we have fast track notes. So whole chapter is summarized in just 2 pages, and these 2 pages are more than enough for your exam purpose. Okay, so you can use these notes. The fast track notes are also part of Essentials course, so you can use these fast track notes for your revision purpose, right? So let's come back to our discussion, and before we begin our discussion, my introduction. My name is Shashank Pandey. I'm certified FRM and I'm faculty of FRM Part 1, Part 2, CFA Level 1 and CA Final, SFM, Strategic Financial Management. Right. So let's start with the basic overview of the discussion. Now we all know the risk and reward or return relationship. So if we take more risk, we will be able to generate more return, and we call this as the more risk, more return, right? Let's understand this from the bank's perspective. Now, bank provides multiple types of loans, say home loan, car loan, and credit card loan. Generally, for the home loan, bank charges say 9%, for car loan say 12%, and for credit card loan, it can go up to 35%. If you are not from India, so these are the rates currently in India. Okay, so if you are in USA, the rates are pretty lower for all these loans. Now here, for home loan, bank is charging 9%, and this 9% is return for bank, 12% for car loan, and 35% for credit card loan. Obviously, all these are the returns. Here, when bank charges 9% on home loan, the reason is very simple. Because the house is mortgaged with the bank, and if the borrower defaults, the borrower who borrowed home loan defaults, in that particular case, bank can sell his assets, that is a house, and bank can recover their money. And that's the reason bank is taking less risk here. And because bank is taking less risk, meaning bank will get the lesser return. If you consider the credit card loans, in this particular case, if the borrower defaults, bank don't have any measure to recover that fund. Okay, those funds. So in this particular case, bank is taking very high risk, and that's why bank is charging higher return, right? So here we understand there is a relationship between the risk and return. Meaning, if the bank wants to earn higher returns, bank needs to take more risk. Simple. Then why don't banks simply take whatever risk comes in their plate? So the reason is bank have risk appetite. Risk appetite means there are limit to take risks, right? And bank must take risk, but within certain limits, so that bank can generate certain profit, okay, or the substantial profit to fulfill their shareholders' requirement. So this is the bank's purpose. Here we have two terms, return and risk, which are related. Okay, so if you want, as I said, higher return, higher risk, or higher risk, higher return, like this. There is a profession who manages return, and we as a FRM are expected to manage the risk part. In any bank, there are two parts. Okay, for the bank's operation, there is risk part and return part. In FRM's curriculum, we are not concerned with the return part. So we are not going to discuss everything in detail which relates to the return, like how to optimize the return or how to generate the higher return. So all those discussions are not covered in risk management curriculum, because this is a risk management. So our focus will be on the risk. Okay. Now here, the first approach is bank. You need to understand this. So bank must take some risk so that bank gets some return. If bank decides like, okay, we are not going to take any risk, then simply like bank should not do any business, zero business. If bank is provide even a $1 loan to some borrower, then there is a risk of default. Even if it is very minuscule, still there is a risk of default, and bank will take that risk, and in that bank will get the reward in the form of returns. Here, the bank generally performs businesses or the activities like providing loans, making some investments, or their general operations. Bank also strategizes their business, like what should be our strategy? Should we go global, or should we get into some new domain of business, maybe technological improvements and so on. This results into the fractions or subdivisions of risk. For the loan part of the bank, the lending business part of the bank, we have credit risk. For the investment part of the bank, we have market risk. And for the operations part, like the operations as in the employees are working, they are sending mails, they are talking with their clients and everything. So all that operations part, which is not the market risk and the credit risk, which is not the investing and lending. So that operational part generates the operational risk. Bank is strategizing, and this gives the origin or source to the strategic risk and so on. So we will discuss all these risks in detail. Now here, let's start with our discussion. So first, the introduction. So risk is essentially the likelihood that the undesirable things may occur. Undesirable things as in the bank is planning something and something else is happening. Like what happened with the SVB, the Silicon Valley Bank, right? So we all know about the Silicon Valley Bank and what happened there. Now here, these are the undesirable outcomes, and this is not the actual definition of the proper risk management. Okay, so as in the risk. So in risk, we also cover the return part. Okay, so always remember, because risk and returns are related. So return and risk both are covered in the risk part. Here, this is a very basic introduction, which you can anyway understand, like what is the meaning of risk. So risk in simple terms, as given in the GARP's curriculum, is the likelihood that the undesirable things may occur. For example, if you own a car, someone might bump into your car, and you may need to get that car repaired. So there is an undesirable outcome, okay, or undesirable thing that someone bumped in your car. And now you have to spend money to repair your car. And this is the outcome of this particular risk. Okay. So simple. And this outcome has a monetary value. So these are the monetary losses. And that's the reason we manage risk, right? So first of all, we'll start with the types of risk. In the types of risk, we have market risk, we have credit risk, and then we also have liquidity risk, operational risk, business and strategic risk, reputation risk. Okay, so I have to discuss everything in detail. So we'll start with the market risk. Market risk is simply when the bank invests in some securities are in the shares, bonds and everything. There is a risk of price fluctuation in those securities. So if the price declines for those securities, bank may generate losses. So in this particular case, the bank is facing market risk. Market risk specifically relates and only relates to all these things, like the investments bank is making and risk generated from the price fluctuation. Price fluctuation, okay? So price and interest rate fluctuates. Even interest rate ultimately impacts price. So main source is price only. And causing the value of the security to rise and fall, and this rise and fall will result into the market risk. The price volatility simply means the fluctuation. So price volatility is the source of market risk. These swings creates the possibility of losses. Market risk can manifest itself in variety of ways. It can manifest itself in the stock risk, interest rate risk, currency risk, and the commodity risk, depending on what type of investment you are making. If you are investing in stock, then there is a stock risk. If you are investing in bonds, then there is an interest rate risk. If you are investing in the currencies, like if you are into the foreign exchange operations, then there is a currency risk. Currency risk as in you purchase dollar. Now the dollar's price declined. So dollar was your asset, dollar's price declined, and this is your currency risk. Commodity risk, you invested in commodity like the gold, you purchased gold and the gold's price declined. This is the commodity risk. So these are the type of risk. Market risk can be divided into like mainly two parts. So first is the general market risk, and then we have the specific market risk. General market risk is the asset class will fall in value, or it can be in the form of individual asset or in the portfolio. So asset classes will fall means whole market is going down, or the segment of market is going down, or maybe going up. Okay, so there is a fluctuation in the segment or whole market. So this is the general market risk. When it comes to the specific market risk, this means the individual firm specific risk. That is, the individual asset will fall more than the general class or the general market. So market is there only, market is stable, but there is say bad news for one company and that particular one company's share prices dropped. So this is market specific, sorry, the general specific risk. Okay, so firm specific risk. Now here, the correlation plays very important role in risk management of market risk part. So what is correlation? Correlation simply means, here please note, I'm assuming you are taking this chapter as the first reading in your preparation. Okay, so you're starting your preparation with this chapter and you don't know anything about the correlation. Now correlation simply means there are two assets, asset A and asset B. You are holding both the assets, both the shares. Okay, maybe $10,000 worth asset A and shares A. Shares and assets are replaceable here. Okay, and then 20,000 in asset B. If both are very positively correlated, in this case what happens? If the asset price of A, the A's prices falls, then B will also fall because these are positively correlated. If A falls, B falls. If B falls, A falls. Meaning you will generate higher losses in this particular case. And this particular thing is known as no diversification scenario or less diversification. Okay, so you are not diversifying your portfolio. On the other hand, if there is a negative correlation, this means if the asset price falls for A, then B's price will increase. Simple. Now here see, you are generating losses from A, but at the same time you are generating gains from the B. Why this is happening? Because there is a negative correlation. With this negative correlation, you can manage the risk of losses. So here simply losses are compensated by the other assets. Losses of one asset are compensated by the other assets. And this is our risk management. So we manage risk with the help of correlation by selecting assets in our portfolio which have the negative correlation or very low correlation, and that's the purpose. That's how you manage the risk. And this is only applicable for the market risk. Now the market risk, we'll just read out this particular part. So correlations between the positions can be used to measure or manage the market risk. A large portfolio diversification benefit is in the form of, you will get the large diversification benefit in the form of negative correlationships. Okay. Then however, the market risk occur as a result of interrelationships, of these interrelationships. For example, the position designed to balance off the another position, that is, we talked about the negative correlationship, right? If this is done in an imperfect way, you have asset A, you have asset B, but you haven't calibrated their diversification properly, then it will unnecessarily impact your risk management and you may generate more risk. And this type of risk is also known as the basis risk, and we will discuss more on basis risk in coming discussions in book 3, I guess reading number 5. So here, just know there is something called basis risk, and basis risk is discussed in detail, remember. Now here, whenever I'm saying like we will discuss basis risk, right now just remember the term and we will discuss everything in detail. This happened like a few attempts back. One of the students says like, I say just remember the term for now and then we will discuss everything in detail. How to remember the term? How to just know the term and move on? It is not possible for me. So I asked him very simple question. If there are two smartphones, Okay, so smartphones. And one smartphone is 4G phone, one smartphone is 5G phone, 5G technology, 4G technology. And the features and the price of both of these phones are exactly same. Exactly same. There is no difference. Price is also same. Which phone you will buy? So he said, I will buy 5G phone. Okay, now I asked him like, okay, explain me the 5G technology. So he's like, how can I explain the 5G technology? I don't know anything about it. Now you're taking decision of buying 5G phone just by knowing the term 5G, because you know this is more useful, this is more beneficial, this will give you the higher internet speed. So here you don't understand any background, but still you are able to take the decision. But just by knowing the term, this is exactly how you take or how you understand this particular chapter, because every term is discussed in detail in coming chapters. Right now, just stick to terms. Accept that you have to just know the terms right now, and not knowing it in detail will help you a lot in your preparation. Otherwise, if I give you overview of everything, then this will lead to unnecessary confusion, which is not at all required. Okay, so it is always better to discuss things in detail, which requires a detailed explanation. For example, the 5G technology, right? So here, next is this mismatch is bigger challenge for risk managers than the single market risk exposure. Now, we will discuss in book number 2. There is a correlation, beta correlation and everything. Now, managing risk means the first one of the part of managing risk is managing all these correlations, or having or structuring your portfolio in such a manner that it is well diversified and one particular firm specific risk is not impacting our portfolio. And that's our whole goal of portfolio management or the risk management when it comes to the market risk, right? So right now you have to just understand this statement. Then we have the credit risk. Credit risk relates to the lending business. Whenever the bank is providing loans, this is one of the source of credit risk. It mainly relates to the lending business. Whenever bank is providing loans, the borrower might default. In that particular case, when the borrower is defaulting, so bank will lose funds, right? And this is the credit risk. That is the risk generated from credit activities. There is one more source of credit risk. Okay. Now this source comes from the derivative contract. Now derivative contract, I will give this simple explanation. Again, I am assuming you understand nothing about the finance world, and that's why I am explaining everything in very layman's term. When you jump into the derivative section, which is the financial instruments or financial securities, the derivatives, that section, you will understand what is derivative. Right now I am giving you very layman's explanation. We entered into contract, and this particular contract is a betting contract. Okay, betting is also derivative. It derives its value from the event. Maybe it can be a cricket match, football match, or everything. Now we entered into betting contract, and this is derivative only. And in this particular scenario, say you are winning. Okay, right now, as per this particular bet, what are the terms of the bet? You are expected to win $1,000 from me, and I'm expected to pay you this particular amount. But once this event is finalized, now imagine the event is finalized. For example, in India versus England, say India scored more than 200 runs, and this was our bet. Okay, I said no, India is not going to score more than 200. You said India is going to score more than 200, and finally the conclusion is that India scored more than 200, say 205. Okay. Now this 205 runs means you won the bet. Now here, this is not the lending business, but still I owe you $1,000. Now, if I default as in, if I say like, no, I won't pay you $1,000 because there was cheating in the match, like that, whatever. Here, you are expected to lose this particular sum, $1,000, which otherwise you were supposed to, like, you would have received if I would have paid you. So your risk of receivable not receiving, okay, receivable as in the amount you're supposed to receive from me, now you are not getting that. This is also risk, and this risk is also covered in the credit risk only. Okay, still this is not the lending business, but there is credit risk. Credit risk simply means the amount which you were supposed to receive is not received, or the counterparty from whom you are supposed to receive, that counterparty defaulted. So this can happen in the case of the lending business, in derivatives business, okay, or the derivative instruments. So we will discuss derivative in detail, and you will automatically understand the credit risk generating from this particular part. We also have credit risk chapter, okay, detailed chapter on the credit risk, and everything will be discussed in detail there also. This is in the book 4. Right now, just we will stick to the basics. So what are the sources of credit risk? So first is the debtor fails to repay loan. This is the bankruptcy risk. This relates to the lending business. Then credit downgrading. This is the downgrade risk. Downgrading means simply there are credit ratings. So AAA, BBB, like this. We have detailed discussion on credit rating as well, okay, in book 4. And these credit ratings are mainly provided for countries and securities and not for companies. So it may be provided for company, but credit rating for company is not that useful. Okay, so mainly for the countries and for the securities. If the credit rating is higher, this means there is a higher credit worthiness for that particular security or the country. If the credit rating is lower, this means higher credit risk. Simple. So rating downgrade is also a form of credit risk, and this is known as a downgrade risk. Then comes the counterparty risk, and the counterparty risk is when in case of the market trade specifically, like what we discussed in case of the betting, in case of the derivative transaction. So in case of these market trades, that counterparty, in our case, in our betting case, I was your counterparty. I was supposed to pay you. So I failed. Okay. So the counterparty fails to pay, right? Here, the proper definition of credit risk, if it gets tested in examination, is when one party fails to fulfill financial obligation, liability, fails to fulfill the financial obligation to another. This is the credit risk, and these are the examples. Now in credit risk, there is a possibility of default, exposure amount, and amount recoverable. Now let's understand the concept which is known as the expected loss. Again, expected loss is covered in detail in book number 4. For now, just the overview. And we will understand this from the perspective of bank and the lending business. Say there is bank. Bank provided only one loan for now, which was $10,000 worth. Now, what is bank's expected loss? Remember, expected loss means there is a possibility that this much loss might happen. So there is a mathematical definition or mathematical explanation for the expected loss. Right now, we are not getting into the mathematics. I'm just giving the brief overview. Once you discuss or once you see the chapter in quants, then you will understand how the expected thing works. Mathematically, there is a meaning to expected term. Right now, I'm just giving you the brief overview. The expected loss, this much you expect. For example, you expect that you will score this much in examination. This is based on the probability, your own assessments, and like that. Okay. So same thing, expected loss, which is denoted as EL. Expected loss is calculated as, what is the exposure currently? Currently, the exposure is $10,000. Exposure means how much bank has a receivable from the counterparty. If that counterparty defaults and bank recovers nothing, so whatever is the amount, which is 10,000. So this is the exposure for bank. If say bank provides loan worth 10 million, then exposure for bank is 10 million, like this, simple. And this is known as the exposure at default. If defaulted, this much is exposure. This means the exposure at default. Multiplied by loss given default. Obviously, if particular counterparty defaults, then it is not like bank won't be able to recover even a single penny. Maybe banks expects like, okay, 50% amount will be recovered, but 50% amount will be lost in this particular case. So this amount lost in case of default is known as the loss given default, LGD. So here we have 10,000 and bank is expecting 50%, denoted as 0.50. So 50% loss given default if the counterparty defaults. And then what is the probability of default? What is the probability? What is the possibility that this particular firm or the counterparty will default? Say it's 2%. So whatever is the calculation here, so 10,000 multiplied by 50% multiplied by 2% is your expected loss. Okay, you can do the calculation, and very simple. This will give you source to expected loss. So you have to remember. Now, similar to expected loss, we also have unexpected loss, and unexpected loss is covered in FRM Part II, credit risk reading number 3. Okay. Now, what is the difference between the expected and the unexpected? In expected, you expect this much loss will happen. In unexpected, you say this was not expected from us. This expected loss is included in pricing. And pricing means, remember, we started with our discussions for home loan, for car loan, and for credit card loan. Bank is charging 9%, 12%, and 35%. Now here, this particular home loan, there is a high recoverability. Okay, bank will be able to recover higher funds, higher exposure, higher amount, right? And that's why there is less pricing impact on this. On the other hand, here bank won't be able to recover substantial sum, and that's why this expected loss will be higher in this particular case compared to the home loan. And for the higher expected loss, this gets included in the pricing. We have to add it in the pricing. So the difference between the 9% and 35% is because of the expected loss. Then there is unexpected loss. As I said, the unexpected loss is which is not expected by the bank, and this unexpected loss is protected by the capital. We will discuss whenever the capital part comes, we will discuss it. Okay, for now just remember this is unexpected loss. Okay, as here also it is mentioned like this is covered in the book number 2. So for now just understand the basic formula and don't bother about it. Right now if you are unable to remember the formula or detailed meaning, when you discuss it in detail you will automatically remember. There is no student in FRM examination who says after exam like, oh, I was unable to recall the expected loss formula. Everyone remembers. Okay, so you will also remember. Now, most loans have the clear level of exposure, while some transactions can be uncertain. Means for most loans the exposures are known, but in case of the derivative transaction, derivative as in the betting example we took. So in case of the derivative transaction, the exposures are not known, and those derivatives or those exposures should be treated separately. Okay. Right now, if you don't know the meaning of derivative, don't bother about it. Just know there is some term known as derivative which acts like a betting, where you may win, might not win, like that. Okay, so there are two possibilities, and very simple. Just remember this for right now. We have whole book on derivative. So book number 3 is on the derivative only. Okay. So derivative, for example, have no immediate market value, thus no credit risk. The position can develop a major counterparty credit exposure if the market moves. Okay, so you may generate losses on derivative, and which are not certain right now. So these are uncertain. How much losses you have to bear in case of the derivatives counterparty default is uncertain. Risk variables determine the likelihood of defaulting. And then you can read out this particular part. This is very easy. The obligor's concentration and the combination of risk factors define the risk in total credit risk portfolio. Obligor concentration means if you are providing loans as a bank, if you are providing loans mainly for credit risk, so obviously that will impact your portfolio. So your portfolio as in total loans provided by your bank. So that's your portfolio. So total risk in the portfolio will be defined by the concentration of the obligors. Obligors means those who borrowed from the bank. So if you have concentration of one kind, then higher risk for specific, say for example the credit card loans, and if you have say loans like the home loans, then the risk will be lower. This is the meaning of the statement. And the combination of risk factors, again, when you discuss the risk factors, you will understand. Portfolio will be significantly riskier if small number of large loans, just 2 loans but in billions. So if one counterparty defaults, then it will impact your bank substantially, right? So if there are high number of loans but very small loans, say $1,000 loans to 1 lakh people, like that, even if like few people defaults, it is not going to substantially impact your bank's position. So that's the meaning of the statement. So small number of large loans, two loans, I'm just giving you the very rough example, two loans which have 100 billion each value. Okay, so this is highly risky. Returns or default probabilities which are positively correlated. Okay, so if the default probabilities are positively correlated, meaning you have 100 borrowers. Okay, 100 borrowers are working in same company. Now they are paying, so all these 100 are say car loans, and they are repaying all the loans or in the form of EMIs, obviously, with the help of their salary. Okay, so they are using salary to pay your EMIs, your bank's EMIs. Now what happens? The company in which all these 100 are working is is in crisis, and the company is unable to pay salaries properly. Now what's happening here? The default of one of these borrowers is linked or is correlated with all the other borrowers. Means all of a sudden, all of the 100 borrowers will stop paying or will have trouble paying EMIs. So this is higher correlation. Okay, if these are positively correlated, then your bank will generate higher risk. So that's what we need to understand. So returns and default probabilities, if these are positively correlated, then there will be higher impact. If these are negatively correlated, all these 100 are working in different companies. If one of the companies is in crisis and maybe one of the borrower is unable to pay his EMI properly, then still, okay, you are not in problem because 99 are paying properly, like that. The exposure is always amount. Exposure, probability of default and loss given default are positively correlated. If this is happening, means the exposure, probability of default. If there is an increase in probability of default, the likelihood of company defaulting or the counterparty defaulting is increasing. Exposure is also increasing, and at the same time, loss given default is also increasing. If all are increasing at the same time, as we discussed in this formula, exposure was 10,000. Okay, so exposure won't increase in case of the loans, but it will increase in case of the derivatives. Exposure, this is loss given default, and this is probability of default. Assume that there is positive correlation between all three. If this increases to say 3% and this increases to 70%, and this increases to say 50,000. So these are positively correlated, and it will increase your expected loss calculation. Expected loss means higher risk. Then we have the liquidity risk. Next discussion. Okay, so rest of the portion is covered. Now here, this particular point you will understand in better manner again once you finish your curriculum. Automatically you will understand. You don't have to do anything. Automatically you will get it. Now we have the liquidity risk. Liquidity risk means simply how much liquid funds you have. Okay. So let's take the example. Say you are working in a bank, or you are the bank. You have 100 billion worth, say land and building. And you have upcoming liability. Your bank has a payable in this particular month, which is of say 10 million. Okay. So if you just consider this, like you as a bank have to pay 10 million, and you have 100 billion worth assets, like so many assets, and it is very easy to pay, right? But this liability must be paid in cash. And right now you have cash amount is equal to $200. Okay, so you have to pay $10 million, and you have cash balance worth $200. You have huge assets. So now you have to sell these assets, and we all know selling assets is not a very easy thing. It is not possible to easily liquidate these assets. Liquidating these assets simply means converting these lands and building into cash by selling it. Simple. So it is not very easy to liquidate these assets. and this will generate a liquidity risk because you don't have enough liquid means cash here, or cash equivalent, like the easily sellable security, shares, bonds, like that. You can immediately sell those shares or bonds. So you don't have cash and cash equivalent. So this particular situation gives rise to liquidity risk. In this particular case, your bank might default. Bank will default not because you don't have enough assets to cover your liabilities, just because you don't have enough cash to pay for liabilities. That's it. Very simple. Okay. And this is the liquidity discussion. So liquidity risk discussion. So liquidity risk can be divided into two parts. First is the funding liquidity risk. Second is the market liquidity risk. These two risks are very different. Funding liquidity risk means in this particular case, what is possible for this particular bank? This particular bank, say U bank, okay. So this particular bank could have borrowed 10 million by pledging 100 million worth assets, because land and building is available there. So maybe it can be like the $10 million can be easily borrowed from any other bank by providing collateral. Okay. So as a security, it is possible, but say like all the other banks are saying, no, we are not going to provide you any funds. This is funding liquidity risk. Funding liquidity. Bank is unable to generate funds by borrowing, and this is the funding liquidity. So here is the risk that corporation will not have enough liquid cash or asset to pay its obligation. Now here, bank faces the unique type of funding liquidity risk due to their business models. And here, this funding liquidity risk, all the business faces the funding liquidity risk. For example, many small and developing business struggle to pay their payments quickly enough while still investing for future. Okay. Now here the bank faces a unique type of funding liquidity risk due to their business model. For example, the bank tries to take in a short-term deposit and lend them in the long term. So what banks are doing? Banks take short-term deposit, as in the deposit for say 1 year, and lend it for say 10 year on home loan. Okay. Now the problem in this particular, this is known as a liquidity mismatch, maturity mismatch. So what happens here? If this particular depositor says, okay, I want my funds back, but bank don't have funds because bank lent these funds to some other borrower. Now this will create a problem for banks. So this is the source. So short-term deposits, long-term loans. What are the possible solutions here for the bank? Nothing apart from like borrowing from some another bank. It is not possible for the bank. Now here, to reduce the risk, good asset liability management, ALM, is essential. Asset liability management is the maturity management, like have the approximate maturity of the deposit and the lending in a particular manner. Again, ALM is discussed in FRM Part II's curriculum, so not in the FRM Part I. Then we have the market liquidity. Now market liquidity is slightly different. So funding liquidity relates to the funds. Okay, you are unable to borrow funds. You don't have currently, like, first you don't have cash, as well as you are unable to borrow funds. This is funding liquidity. Market liquidity means you have stocks and you want to sell these stocks, but you have stocks worth 100 million. And in market, there are no enough buyers to buy these 100 million stocks, 100 million worth stocks. So what will happen? If currently say current share price is say $50, because there are no enough buyers and you are generating sales pressure, so more supply, less demand. In this particular case, you will end up selling your assets or these particular securities for lesser price to motivate more buyers so that they will buy your securities. Okay, so which you want to sell. And this is known as the market liquidity risk. Market don't have enough liquidity and you are trying to sell it. If there are say enough borrowers, okay, and they are ready to buy say 200 million and you are just selling 100 million worth securities, then you won't face any problem. But if there are no buyers or say very less number of buyers or they are looking just for say 10 million worth securities, and you are dumping 100 million worth securities in the market suddenly, market is not ready to absorb. There is no enough demand for your 100 million. So automatically price will decline. So this simple law of economics. So more supply, less demand means price will decline. And this price decline is known as the market liquidity. Remember this. Market liquidity risk. So the trading liquidity risk is the risk of asset value loss when the market abruptly sees up or there are no enough buyers in the market. As a result, seller may be forced to accept abnormally low prices, lose the power to convert the asset into cash and finance at any price. So lose the asset into cash means if this particular investor decides or the bank decides, no, I will sell it at $50 only, 50 per share only, and I want this price only, you won't be able to sell it. Okay. So if you're not unable to sell it, you are not able to convert your securities into liquid or the cash. Okay. So this is also the type of market liquidity risk. The market liquidity risk can quickly become financing liquidity risk if the banks rely on volatile wholesale market to raise the cash. Volatile wholesale market means there is high volatility and there may be financing liquidity. Financing liquidity comes from, as we know, so bank don't have enough finances, the kind of funding liquidity. Okay. Market liquidity risk is difficult to quantify. In regular market, liquidity is measured by the number of transactions and bid-ask spread. What is bid-ask spread will be covered in the book 3. However, these are not always reliable indications of market liquidity in crisis. Now we have the operational risk. General definition of operational risk is whatever, from the bank's perspective, whatever is not market and credit risk is the operational risk. Whatever risk bank is facing, if it is not market and credit risk, exclude those risks. Leftover risk is the operational risk for the bank. It can be the hackers hacking bank, earthquake, maybe there is flood, maybe there is a climate risk right now. Okay, so climates are changing, there is global warming, because of that bank might lose their investment values and so on. So all these risks which are not in the market and credit are operational risk. There can be employee fraud, okay, cash embezzlements. So all these are operational risks. Now there are multiple definitions of operational risk. We are reading the specific definition provided by GAP here. In FRM Part II, you also have the alternate definition. Insufficient or failed internal procedure. These are the sources. Okay. So insufficient or failed internal procedures or process, people, system or external event constitutes operational risk. It excludes business risk and reputation risk. Very important point for exam. It excludes the business risk and the reputation risk. What is business risk and reputation risk? We will discuss it later. But right now you have to understand any risk generated from the failed internal process, meaning cash embezzlement is happening. Okay, so someone is laundering money with the help of your bank. So this is failed internal process. You don't have internal checks to identify and detect the money laundering activities. If this is happening, this is failed internal process. Failed people. People means there is an employee who committed fraud. Failed people. Failed system. Your computers crashed. Bank server crashed. Failed system. External events. Earthquake. War. Nuclear war. Like that. Okay. It constitutes the operational risk. Again, the examples are given here. You can read these examples. And all these are examples only. Okay. Then we have the business and strategic risk. So business risk includes client demand, pricing decision, supplier agreement, and the product innovation. Now understand, business risk is not the strategic risk, and this is the GAP's favorite area. Now see, understand what is the business risk. Right now, whatever is your bank doing in its operations or in business, those things are or may create a source for the business risk. Maybe you priced your product in a wrong manner, so you don't have enough demand, right? So this is the business risk. Maybe there is like you don't have good reputation or good connections with the clients. Okay, so then this is again the business risk. Maybe you entered into some wrong agreement. Then again, this is a business risk. You're not innovating your product unless you are Apple. Okay, so Apple can sell same iPhone for like back to back 4 years, right? But for other companies, if you are not innovating your product, there is no new things in your product. So obviously, this is a business risk. Business risk comes from by conducting the business in ongoing business. On the other hand, there is also strategic risk. Now, strategic risk is when you want to enter into new domain. For example, your bank wants to enter into, say, new geography, new country, and in that particular case, this is the strategy, right? Okay, so how we will enter into that particular country and set up our operations and like develop our customers. This was your strategy, and your strategy failed. If your strategy fails, strategy will always come when you are doing something new. So always remember this. If you are doing everything for the existing business, this is for the business risk. If you are doing something new, in that particular case, this is the strategic risk. For the new things, you have new strategy, and your strategy must fail for the strategic risk. The major strategic decisions generally involve significant cash, human resource, and management reputation investment. Okay. The business and the strategic risk occupy most management's attention in non-financial organizations. Okay. So non-financial as in, or not banks, not hedge funds and like that. Maybe manufacturing company, Apple Incorporation. Okay. Now, as they definitely do in financial firms. But it is not clear how they link to other hazards or how they fit into each firm's risk management system. For example, please note business risk is the risk of or in ongoing business in current state. However, strategic risk involves the risk in expansion plans, new prototype development, etc. Very important for your exam. Please note it down. Reputation risk. Now reputation risk, like just loss of reputation, like that. Now the most reputation risk occurs when another risk is generated. Okay, so another risk manifests. Maybe there is a market risk. So you have your bank failed to manage their market risk. Now, from the client's perspective or from the customer's perspective, your bank lost the reputation. Okay, that you can't manage funds properly, and that's how the reputation risk originates. So reputation risk has a different source. Okay. So the impact or the outcome is reputation risk, but the source may be market risk, operational risk, or the credit risk. Area of risk. So management fails, causing loss of faith in the firm's financial stability or the reputation for the fairness. Bank must prepare plans to reassure markets and restore their reputations. These are the solutions for reputation risk. And regulators' reputation is crucial to financial organizations. Regulators possess significant informal and formal power. If the regulator loses their trust in the bank, its action may be criticized or limited. Now, this is from the perspective of like regulators' reputation means the perspective is in the eyes of regulators, your bank should have some reputation. Okay, if maybe from the customer's perspective everything is fine, from the regulator's perspective things are problematic. Maybe you are not submitting monthly reports properly in due time, so there might be some limitations, some actions on from the regulator's standpoint. Now the risk management process, how the risk management process is conducted. Now this particular section will be repeated at least 10 times in your curriculum. Okay, so this identify, analysis, assess the impact and manage the risk. So in risk management process, imagine you just started your bank and you're planning some activities. So first job is to identify what type of risks are there for your bank. Every bank is in different business or in different proportion at least. So every bank is exposed to different types of risk. Even if those risks are can be categorized under the same. So market, credit, operational, these are categories of risk, but the underlying causes or source or identification of risk can be different. So imagine for now, your bank is exposed to risk 1, risk 2 and risk 3. These are three types of risk. Now for risk identification, you have to conduct a brainstorming session, some meetings and everything. So all these stakeholders or the major employees of your bank, the key persons of your bank, main management, senior management will sit together in one room and they will discuss, okay, let's identify the risk, what type of risk we are exposed to. Now here, your bank was able to identify risk 1 and risk 2. Once you are able to identify risk 1 and risk 2, then you will be able to assess its impact on your bank. You will be able to manage all the outcomes of that risk. However, if you fail to identify one particular risk, you won't plan anything. So that's why the identification of risk, identifying what type of risks are there for our bank, is very crucial. Okay. As we discussed in the first example a few minutes back. So if one owns car, then he must have some insurance because there is a risk, accidental risk for his car, right? So you as the user needs to identify what type of risk he is exposed to. Imagine for now, there is one particular person, he don't own any car and he wants to buy car insurance. Like, what's logic in that? Because he is not exposed to that risk. So every individual bank must assess or identify first what is the risk. So identification is simply the literal meaning, identification. Analyze means understand its nature, how it will manifest, how it will impact our bank. So this is the analysis. Assess the impact, quantify the impact. What will be the impact in dollar terms? Okay. And this can be a quantitative impact. Okay. Quantify the risk and assess the impact on the firm, maybe loss of reputation and so on. And then manage it. Okay. Manage means how to manage. There are multiple methods to manage risk, which we will discuss here, and simply manage that particular risk. Now, management does not mean elimination of risk. Very important. You need to remember this. This does not mean elimination of risk, because you must take, as a bank, you must take risk to generate profits. So management of risk has mainly four options, like how to manage risk. So these are the four options. So first is avoid, second is retain, third is mitigate, then we have transfer. Avoid means completely avoid it. Maybe your bank is not ready to take a particular type of risk, then strictly avoid that particular risk. Okay. How you will avoid? By not entering into that particular domain. Maybe your bank is not ready to face the risk from the credit card borrowers. Okay. So credit card loan borrowers. So don't enter into the credit card business. Simply stick to home loans. Simple. Okay. So this is the avoid. If your bank is not ready to take the losses from derivatives trading, okay, maybe ready for stocks but not derivatives, don't enter into derivatives. This is the avoid. Simply avoid. Now, there are dangers that can be avoided by closing the business or changing the strategy. Exporting to specific markets or outsourcing production is maybe to avoid outsourcing production may be avoided to reduce the political and the currency fluctuation concerns. Don't bother about the example. It is simply you have to take some measures to avoid the risk by not entering into the business or changing some strategy. For example, from the Apple incorporation's perspective, so say they had a plant in China first. Now they don't want to take that particular risk because in China we don't know what happens, right? So anytime anything can happen. So for that they wanted to avoid that particular risk. So what they did? They tried to shift, or they started their shifting their business or the manufacturing operations in India. Now here they are shifting their operations in India. They're changing their strategy to avoid the risk. Then we have retain the risk part. Retain the risk means, okay, this much risk you can take. For example, when the bank decides to get into the car loans business, okay, they are like, okay, this much risk we can take. Even if some borrowers default, we know we will be able to manage. And this, how much to retain, how much risk to retain is based on the risk appetite. Risk appetite. What is the risk appetite? This is the limit to which bank can consume risk. For example, we have appetite, food appetite. So we know how much food we can intake. So for the bank knows the risk appetite. So this much risk limits, these many limits we have. Okay, this is our limit, and this much risk we can take. That's it. Okay, so this much you must retain. If you have the risk appetite of say 100 million, then you have to take that much risk. Okay, so 100 million comes from this is the appetite is based on generally alternative measures as well as the capital. Okay, so there are multiple measures to set the risk appetite, and risk appetite setting is an activity. Again, we will discuss this in the FRM part 2 operational risk part. Now here, some risks are within the firm's risk appetite. Then we have the captive insurance, and risk capital allocation can maintain the large risk appetites. Okay, so simple. If you are looking to have risk in your portfolio, you have to put some capital. Okay, have some funds, and based on that, you will be able to take that risk. Then we have mitigate risk. Okay, so mitigation risk means simply the exposure frequency and severity can be reduced. So instead of, say, as a bank, we want to enter into credit card business, but we don't want to take high risk in that. Maybe we want to enter into derivatives business, which is very risky business. Losses might be substantial, but we don't want to take that much losses. Okay, we don't want high losses. Still, we want to stay in that business. So we can mitigate it by reducing exposure or entering into derivatives which have less risk, like that. Okay, so these are the options. So mitigating means actually reducing the risk's impact. Avoid means completely avoid. Retain means have it in your portfolio, and mitigate means reduce the impact because it is going beyond your risk appetite. Again, here also we will consider the risk appetite. Example, improved operational infrastructure can mitigate the frequency of some kind of operational risk. Hedging unwanted foreign currency exposure can mitigate the market risk, and receiving collateral against the credit exposure can mitigate the severity of the potential default. Even if you don't understand a thing, I'm assuming you are very new to this particular curriculum or finance world, don't bother about it. Whatever is written in this particular paragraph, you will understand automatically by the time you finish your curriculum, because everything is covered in your curriculum. Don't bother about it. And if you don't understand what is hedging, how it works and everything, again, we have full chapter on hedging. Okay, so there you will understand how hedging works. So always ensure, be assured, whatever you're not understanding here, you will understand in the coming discussion. Then transfer risk. Transfer risk means, again, the car example. Say I have car, okay, and I don't want to pay for the repair cost of the car in case of the accident. So what I will do, I will get the insurance, car insurance, right? So similarly is applicable for the house, property and everything. So this is the transfer risk. Transfer means I'm transferring my risk. What is my risk? That I had to pay the cost of repairs in case of accident. So what I will do, I will get the insurance. I transferred my risk to insurance company. So risk transfer can be done with the help of insurance, okay? Insurance or derivatives. Derivatives are like betting. For example, I will give you again an example. We enter into bet. I say if my car bumps, if someone two-wheeler bumps into my car, then you will pay me XYZ sum of money. So what I'm doing here, I'm entering into derivative. Derivative is similar to betting, okay, but more sophisticated version of betting. So we are entering into bet. This is a derivative, and ultimately you will pay me if my car bumps, right? So simple, very simple. So with the help of derivative, structured product. What are structured product? We will discuss it in detail in later chapters. Or by paying a premium, that is for the insurance only, okay. In modern economics, risk management is more than just survival. It's vital to specialization, scale, efficiency, and wealth development. In order to develop wealth, in case of bank or in case of any firm, risk management is very important, because even if the bank is able to survive after some risks are materializing, okay, maybe there is employee fraud in your company or some other type of things. Even in that case, if the bank loses the reputation, bank won't be able to generate higher wealth. So in order to higher wealth, risk management is important. And this is very crucial statement. So in exam, if you get a statement which says in order to survive, so bank's objective of risk management is this survival. So always remember that statement is wrong. No, bank's objective of risk management is wealth optimization or wealth increase, increase in efficiency, scale, specialization and everything. Okay. Risk never goes away. You have to remember this. If you don't take risk, there is no business. Simple. Now we have very special discussion. Known versus unknown risk. Now what are these known and unknown risk? I will simply explain you from this particular table. Known risk means there are two aspects to it. Known versus unknown. The known part of this risk means you know about that risk. You have you have identified that particular risk. Okay, this is the risk which we are going to face and we have to manage it and mitigate and everything. So the known part is first the type of risk, and to this we also have quantity. So type of risk and quantity of risk. Fine. Now what is the type and quantity? So I know I'm exposed to, as a bank, I'm exposed to market risk, which is worth say $10 million. 10 million worth risk. So I know the quantity and type. So this is your known. Okay. So I know the risk, I know the quantity. There is a possibility that I know the risk, but I don't know the quantity, right? There is also a possibility that I don't know the risk and I don't know the quantity. All are possible. Okay. So this is what is given here. So first we have the expected losses. So expected losses are the losses which are coming from known risk, but at the same time, with the known quantity or the known impact. So this is known. Both are known. Okay. We know the type of risk. Obviously, to quantify something, you must know that particular thing, right? Second is unexpected losses. We know the risk. But it is difficult to quantify. So unexpected. So the losses, we know these type of losses might happen, but unexpected. Okay. So we can measure it to certain certainty. Okay. But still things are very uncertain there. So like that. So unexpected, which are not expected by us. I expected that 100 borrowers will default. This was expected as per our previous calculations, but 150 defaulted. Now what's happening here? 50 more defaulted. So this is like unexpected for me. So the unexpected loss. Then we have known unknowns. We know the risk, but we can't quantify it at all. Here we still know how it will materialize. But in case of known unknowns, this is also known as Knightian risk. Okay. Knightian uncertainties. Known unknowns. I know it. I know the risk, but I don't know its impact. For example, if the nuclear war happens, I know this type of risk exists. Okay. If your bank is in specifically UK or Russia or Ukraine, in that case, we know there is like currently war is going on and anything may happen, right? So we know the risk, but we don't know the final impact. We can't quantify it at all. Okay, that's the known unknown. And this is, the bank should always try to measure or try to know both the parts. So known, for the known risk, try to assess the impact. And then we have the unknown unknown. Unknown unknown means neither the risk is known, obviously its impact will also be not known, right? So if you don't know the risk, this type of risk is there. Okay, maybe like we know, as in like on Earth, we know there is a possibility of someday asteroid might fall on our Earth. Okay, so on even like there are asteroids who are like falling on Earth. So we know this type of risk is there, but we don't know the exact impact. So this is known unknown. On the other hand, unknown unknown means, for now imagine like maybe just from the Earth's center, you must have watched that Eternals movie, right? Eternals movie. So someone like, I'm not able to recall that specific name. So someone comes out of like from the core of Earth. Okay, that type of thing. Right now we don't know such thing can happen. Right? So the unknown for us. Obviously we can't measure the risk. Okay, so that's the unknown unknown. Right? So you have to understand these things. And the risk management, the good risk management practices says the management should always seek or should be in the process or continuously look for the unknowns. Why? Because if bank fails to identify some important unknowns, there will be huge impact on the bank. So this should be the aim of bank. Okay, so try to identify the unknowns, and this is what is written in this particular paragraph. I have to just read it and you will understand. Then there are two types of quantification, tools, risk management tools. So first is a quantitative tool where we actually measure the risk, and qualitative tool where we qualitatively identify the risk. Okay, so in quantitative measures we have value at risk, expected shortfall, unexpected loss measure. In GARP's curriculum you are provided with the information on these, and I know you are facing a lot of difficulty in understanding these concepts. So don't try to understand these concepts at this particular point. We have full discussion on value at risk in book 4. Right now just know the words value at risk, expected loss measure, that is expected shortfall, and unexpected loss measure. Fine, we will discuss in detail. And these are quantitative measure where we will quantify the risk. Right now I'm totally ignoring this particular part, because anyway if we try to discuss it, it requires a lot of quants. First you need to first finish your book 2, then book 3, then book 4, like that. So obviously in one chapter I can't finish book 2 and book 3, and that's why we are not discussing it. And that's why you are facing difficulty in understanding that chapter, because you don't know the background right now, if you are facing difficulty in understanding chapter. Then we have the qualitative risk measurement tools. What are the qualitative? Stress testing and scenario analysis. We have full chapter on stress testing. Okay, so stress testing will be discussed there. Now there is a risk and reward relationship. We'll just read out the paragraph, and here we have the most important concept again, which is not discussed again in FRM Part 1's curriculum, but we have full chapter on RAROC in FRM Part 2 in operational risk chapter, I guess chapter number 17 if I'm not wrong. Okay, so a war technique can assist to compare the risk exposure. Okay, so if there are say two assets, war of asset A is say $10 million and war of asset B is say 12 million. So war stands for value at risk. So this is the risk measure. This is used to quantify the risk. So I will say, okay, this is higher, more risky. The firms learn to expect and avoid losses associated with these certain activities. The firms can also protect itself by ensuring that its risk capital is sufficient to absorb the unforeseen losses. Now here, we know the expected loss, we know the unexpected loss. Expected loss we already discussed, it is adjusted in pricing. Unexpected loss is managed with the help of capital. Okay, how it's done? Let's see. So you start your bank, or you maintain say 100 million worth capital in your bank, and you were expecting approximately 10 million worth losses. 10 million worth losses. But what happened? Actual losses for that particular year went up to say 15 million. Okay, now you have 5 million extra losses. Now how your firm or a bank will absorb these losses? With the help of capital. Now these losses will be absorbed with the help of capital, buffer. And how it's done, again you will understand afterwards, but right now this is how it's done, and this is applicable for any business. Okay, so say you can imagine the very basic business. You have say ice cream shop, and you maintain capital say $10,000. Okay, say there is like one day some robbers came and stole all the ice cream. Okay, now after this you want to continue your business, and this is your capital, by the way. Okay, so you have this capital of 10,000. Now you want to continue your business. So how you will continue your business? Obviously you have shop now, but you have new losses which were unexpected by you. You never expected this. So now you can use your capital and invest this capital to buy new packets of ice cream which you can sell and continue your business. When you buy new packets, automatically, say assume it costs you $5,000. What will happen? Your capital is used to absorb these unexpected losses. Now your remaining capital is only 5,000. Okay. So with the unexpected losses, your capital will reduce. With the gains or the regular incomes or the maybe unexpected income also, your capital will increase. Very simple. And same thing is applicable for the bank. Capital means the funds which are in capital. Okay, it is very difficult to explain capital, by the way. So simple. Now here, this particular capital, when it is calculated by the bank itself, then we know, or we call this as economic capital. There is also regulations. Okay, there are regulations, and regulators say, okay, you must maintain this much capital if you are doing this type of business. So how this capital is calculated? We have this discussion in the book number 3 of FRM Part 2. This is known as regulators capital or regulatory capital. Okay, so economic capital as per the bank's calculation, regulatory capital as per the regulator's requirement. Let's imagine, as per your own calculation, your own bank's calculation, you think $100 million is sufficient for your bank. But as per regulator's requirement, say it is 110 million. Then how much capital you need to maintain? This much, 110 million. On the other hand, if economic capital is 110 million as per your calculation and regulator says you have to maintain 100 million. Now this is your minimum. You must maintain your minimum capital because it's a regulatory requirement. But it is very good to maintain the economic capital because you want to run your business. Okay, you want to ensure that your business is stable. That's why you should maintain economic capital in this particular case. So ideally whichever is higher, but when the regulatory capital is higher, it is must. When the economic capital is higher, it is recommended as a good business practice. Okay, then with this economic capital, for example, whenever you are purchasing any, like say shares, you purchase shares worth $100. So this is the capital you are putting. Okay, and you have some expectations of return, and say you bought this share for $100 and at the end you are able to sell it at $110. So what is your return on capital? Return on capital, this is your return. Return is 110 minus 100. 10 you earned and your capital is 100. So you were able to get the 10%. So return on capital, whatever capital you are putting and whatever returns you are getting. So this is return on capital. There is something called RAROC. This is risk adjusted return on capital, and this is applicable for the banks. Now see, here if we consider this particular formula, this formula is return divided by capital. For bank, this capital is economic capital, and please remember this is not the regulatory capital. Okay, so economic capital. In return, You can have normal income minus expenses or revenue minus expenses and you will get the return. But we want risk adjusted return. We want to give the adjustment for risk, and that's why we will reduce the expected loss from this particular return. So this expected loss is not actually adjusted in your balance sheet or profit and loss statement, but it is only adjusted in this particular calculation. Okay. So return, whatever is your return as per your statement, income statement, as per income statement of your bank. So return minus expected losses divided by economic capital. Imagine post-tax return. Okay, so return attributable to equity is 100 million. Expected loss is 5 million and capital base is say 20 million. It is too high. Just a second. Capital base is say 500 million. Okay. Now in this particular case, your RAROC, RAROC, is equal to 95 divided by 500. Whatever is the answer, you have to do this calculation. On the other hand, if you just consider the return on capital, then return on capital is this. Okay, 100 divided by 500. Simple. Okay, I hope you get the idea. This will be approximately 20% or equal to 20%. 100 divided by 500, and this will be approximately maybe 18%. I'm not very sure. So you do the calculation. Okay, so RAROC, risk adjusted return on capital, and ROC, return on capital. So 18% and 20%. Very simple. Now here, why are we calculating the RAROC, risk adjusted return on capital? What is the purpose of this? Now let's take the example of two banks. Okay, so there is a bank 1, bank 2. Both have the capital base of 500 million. Both the banks produced return of 100 million. Fine. Now here, if I just provided this much information, based on this, if you calculate the return on capital, you will say, okay, so both the banks are able to produce 20%. So you can invest in any of this particular bank, or instead of bank, you can say shares. Let's take the example of stocks. We can keep banks as well. Okay. And you are investing in bank. Now here, if I simply provide you this particular information, then 20% and 20% for both. That's fine. So is this enough? No, this is not enough. Now the problem is, this particular bank 1 is habitual of entering into very risky business. And for this reason, the expected loss of this particular bank, obviously, if you are entering into higher risk or high risk business, expected loss will be higher compared to if you enter into the low risk business. On the other hand, this particular bank is really nice, bank 2, and always enters into or make sure that the risks are not very high, and that's why the expected loss is less. If I just focus till ROC, I will end up investing in any of the bank, maybe 50% in bank 1, 50% in bank 2. But when I calculate RAROC, risk adjusted return on capital, I will calculate it like 100 minus 50 divided by 500. And then here we will have the 100 minus 10 divided by 500. So obviously the RAROC in this particular case, just a second. This is 10%. This is 18%. Now which firm is better after risk adjusted return on capital? Obviously this one, right? So we will invest in bank 2, and that's why RAROC is important. Now in RAROC, RAROC is used for the multiple purposes. Okay, so first of all, in case of the taking business decisions, okay, so investment decisions. So you say if the bank wants to start a new business and bank's required return is equal to say 10%, and new projects RAROC is 8%. Okay, so in this particular case, bank should not invest in this particular business because the return of this particular project is lesser. The RAROC is lesser compared to the bank's required rate of return. Required rate of return means if I invest in this particular project and this is my expected return, this is what I expect to earn. Fine. Second, there are two businesses as we discussed. So for the business comparison, investment analysis, business comparison we discussed. So bank 1, bank 2, that was the business comparison. Investment analysis, changing pricing strategy. If we know the RAROC is very less, then we have to change the pricing strategy, maybe reduce the expected losses, maybe increase the revenues and so on. Okay, so pricing strategies might be changed. So pricing strategy for the different customers, different customer categories and the product. For example, it may set the price excessively low to achieve the risk adjusted profit on one business sector while increasing the market share in the another. Okay, so it can be any strategy. Just remember for the changing pricing strategy, RAROC is used, and the risk management purpose also RAROC is used. Okay. So risk management purpose is if the RAROC, risk adjusted return, maybe we are able to produce higher returns, but RAROC is very less, then we have to work on the risk management strategy. And we have full discussion on RAROC, as I said, in FRM Part 2, where we will see the detailed calculation, the proper step-by-step calculation. At this particular point, we don't need to bother about the detailed calculation. Okay, so that's all about this particular chapter. See you in the next chapter. Bye-bye, take care.